Welcome to today's Explainer, everyone. Right now, we are witnessing something absolutely massive. I mean, the most valuable companies on Earth are practically falling over themselves racing to sell you their stock. We're talking more money, bigger names, and crazier valuations than anything the stock market has ever seen. To a lot of people, this looks like the opportunity of a lifetime, right? Like the greatest tech boom in history is finally opening its doors, letting everyday folks own a piece of the companies that are going to define the next century. But there's another way to look at this, and honestly, it's a much more cautious one, because to some folks, this isn't a celebration at all. It's a trap, a carefully laid trap. And by the time we finish walking through this explainer, you might just find yourself agreeing with that perspective. Because, well, when it comes to the stock market, an open door is almost never a favor. We are going to look closely at the incredibly dangerous reality of IPOs.
You see, there's a fundamental truth in finance that completely goes out the window when hype takes over. Every single trade needs a counterparty. Generosity isn't really a thing born out of the kindness of someone's heart on Wall Street. Every single buyer needs the seller. Period. So if you're scrambling to buy into some hot new tech stock, you have to realize someone has made the very deliberate decision to sell it to you. And in the case of these massive tech offerings, those sellers aren't just random traders guessing at a computer screen. No, they're the founders who built the companies, the early employees who dedicated years of their lives to them, and the venture capitalists who funded them when they were literally just an idea on a whiteboard.
Which brings us to, honestly, the most absolutely crucial question you can ask yourself as an investor. It's the thought that should be flashing like a giant red warning light in your mind. The one the people behind this hype wave are quietly hoping you just don't ask. And it's this. If these really are the most valuable, most important companies in the world, and if the future is as perfectly bright as everyone keeps promising, then why are the people who know them best in such an incredible hurry to sell them to you? When you break it down, these insiders have looked at the numbers, they know all the inner workings, and they have ultimately decided they would rather have your cash in their pockets than keep their own shares. Let's dive into Section 1, the anatomy of an IPO. So if we strip away the ringing bells on the trading floor, the breathless media headlines, and all the celebration, an IPO actually represents a really dangerous reality known as information asymmetry. Basically, this is a trade defined by a massive imbalance of information. The sellers, those founders and insiders we talked about, they're the most informed people in the room, by far. They've seen the internal metrics, the hidden growth hurdles, the actual terrifying financial burn rates that you and I will just never get access to. Which means the buyer, by definition, is the least informed party in the transaction. And right now, in this massive tech boom, that least informed buyer is you. It's a massive financial hazard. Moving right along to Section 2, the dine and dash pattern. To really get why this is so dangerous, we have to look at a pattern that repeats itself over and over throughout market history. We can call it the dine and dash. Just like a poker player has a tell, that tiny unconscious signal that gives away their hand, markets have tells too. But you don't find these tells in press releases or by watching cable news. You find them by watching what professionals actually do with their own money. See, professional investors sell when everything looks perfect, when the story is the loudest, when optimism is at its absolute peak, and when there's a desperate line of buyers out the door. That is the exact moment you can get the absolute maximum amount of money for what you're selling. Let's trace this back to the dot-com bubble. Look at 1999, the year right before the bubble popped. Tech IPOs hit a record concentration, making up 51% of all companies going public. Insiders got incredibly rich, while retail investors thought they were securing their piece of the digital future. But then, the bubble popped. Over the next 2.5 years, the Nasdaq crashed by more than 75%. That erased an estimated $5 trillion in market value. It literally took 15 years for the market to recover. And worst of all, a major study found that a decade later, only 29% of those emerging growth companies that went public during the boom were even still standing. The assets people thought they were buying simply ceased to exist. And we see this exact same tell pop up right before the 2008 financial crisis. Let's look at June 2007. Wall Street is booming, the markets are scorching hot, and the founders of Blackstone decide, hey, it's the perfect time to go public. Between them, they walked away with about $2.6 billion in cash. Just a little over a year later, the global financial crisis devastated the markets, and Blackstone's stock plummeted by roughly 90%. It is a perfect historical example of the dangerous reality of IPOs. You have insiders extracting billions at the exact peak of optimism, mere months before reality caught up and completely crushed the stock. Which brings us to Section 3, the 2021 SPAC warning. Fast forward a bit to 2021. This whole dine and dash pattern disguised itself as SPACs.
special purpose acquisition companies. These were essentially just blank check companies. The idea was you raise money from investors first, list on the stock exchange, and then go shopping for a real business to merge with. It basically allowed companies to reach the public market without undergoing the rigorous vetting of a normal traditional IPO. And man, the money came rushing in. In 2021 alone, a staggering 613 SPACs went public. But the ending? Entirely predictable. Companies that completed a SPAC merger in 2021 lost an average of 67% of their value. For those in 2022, the average loss was 59%. And notice how incredibly quickly the market vanished, dropping from 613 SPACs down to just 86 in a single year once the rug was pulled. The lesson here? When markets are booming, insiders sell. When they aren't, the selling stops. It's a cycle that just happens over and over again.
All right, let's look at Section 4, the AI spending gap.
This brings us squarely to the present day, right into the middle of this massive AI boom we are currently living through. We have to answer the question, why are the most valuable companies in the world, these fierce tech rivals who literally agree on almost nothing, all racing to sell you stock right at this very moment? The answer comes down to two critical numbers that reveal a massive, dangerous gap. Here's the first number, $725 billion. This year alone, the largest technology companies on Earth are on track to spend this mind-boggling amount building out artificial intelligence infrastructure. It is the largest and fastest infrastructure build-out in human history. To put that into perspective for you, if you spent $1 million every single day, starting from the day Jesus was born, going all the way through the fall of the Roman Empire, both world wars, and right up to today, you still wouldn't have spent what big tech plans to spend on AI in just 1 year. It's roughly $23,000 being spent every single second.
But here is the second number, and this brilliantly illustrates the disconnect. While they are spending that $725 billion, the research firm Exponential View estimated that over the past 12 months, the entire AI economy combined generated only about $110 billion in revenue. And remember, that's just revenue, okay? Not profit. The entire AI economy earned back an amount equal to roughly 15% of what big tech plans to spend this year alone. By absolutely any financial standard, that is a horribly upside-down investment return.
And if you're thinking, well, the businesses actually buying and using this AI tech are probably seeing better results, they aren't. A Deloitte survey actually found that while 74% of organizations want AI to grow their revenue, only 20% have actually seen it happen. But even more shocking is this stat from a recent MIT study. They looked at hundreds of real corporate AI rollouts and found that 95% of them are producing zero measurable return on investment. Literally zero.
And the wild thing is, the market is completely ignoring this gap. Just take a look at OpenAI, the company at the very center of this whole storm. Based on leaked financials, while they brought in around $13 billion in revenue last year, it's reported that in 2025, OpenAI is projecting a net loss of $38.5 billion. By their own internal estimates, they expect to burn well over $100 billion between now and 2029. Yet, despite these brutal bleeding fundamentals, their latest funding round valued the company at an astronomical $852 billion. That's more than 65 times its revenue. Folks, this isn't a bet on a solid business. This is the dangerous reality of an IPO trap just waiting to be sprung.
Which leads us to our final section, Section 5, when the music stops.
So how do we make sense of all this? Let's take a second to understand the psychology behind these massive valuations and the incredibly dangerous game that insiders are playing right in front of us. This dynamic perfectly echoes one of the most infamous quotes in finance history. Back in the summer of 2007, just months before the global financial system nearly collapsed, Citigroup's CEO Charles Prince was asked about their highly risky lending practices, and he replied, "When the music stops, in terms of liquidity, things will be complicated, but as long as the music is playing, you've got to get up and dance. We're still dancing." He wasn't saying the party would last forever. He was flat out admitting he knew it wouldn't. He knew it was a giant game of hot potato, and the only thing that mattered was passing that massive risk on to someone else before the music cut out.
And that brings us exactly to what is happening today. Think about it. Step 1, insiders are hyping a perfect AI future. Step 2, they are watching prices sprint miles and miles ahead of any actual financial fundamentals because they're caught in this crazy expensive arms race with a pretty slim chance of actually paying off. The only rational move they have is Step 3, pass the hot potato. They need to hand off the stock to the biggest, most eager crowd of buyers they can find, the retail market, before the harsh reality of those fundamentals finally catches up to them. So the crucial point we are left with today is this final question. When the music eventually stops, who will be left holding the stock? The insiders aren't dumb. They see the gap, and they are rushing to sell. The reality is, we don't have a magic stopwatch. Nobody knows for sure if this bubble pops in a month, a year, or 3 years down the road. But you don't need the exact date to protect yourself. You just need to be able to read the room. Because you definitely, absolutely don't want to be the last one on the dance floor when the music finally cuts out. Thanks for joining this explainer. I hope it gave you something to think about.